In this video, I'm going to show you how to pay no taxes when you sell your personal residence. In other videos, we've talked only about the property that you've held for investment or rental, and in this case, we're talking about your personal residence. Personal residence defined in the code is actually your primary residence because, you could have a personal residence that's an apartment or a boat or something else. Okay. Here's the issue. In a 1031 exchange, what you're trying to do is defer taxes maybe forever. But with your principal residence, you can avoid paying any kind of taxes, and there's no deferral. You are exempt for a certain amount of taxes. Okay, don't have to pay them at all. And here's how you figure it out. The code is called IRS 121. And 121 says that if you've owned and occupied your principal residence for 2 of the last 5 years, then you can have tax exemptions. This means you don't even have to consider whether you've made a profit on your sale of your house up to a certain amount. If you have owned and occupied your property for 2 out of the last 5 years, and this goes for all of the different exemptions for 121, and you are married, and you both have owned and occupied your property for 2 of the last 5 years, you are exempt, meaning you don't have to pay a cent based on $500,000 of your profit. Let's say that this is a situation where we have a husband and wife, that's you, filing a joint tax return. And remember, you've lived in your principal residence 2 out of the last 5 years. You bought it about 8 years ago. Okay, you have a $500,000 exemption from your capital gains taxes. An exemption means you never pay it. Doesn't mean it's deferred, you never pay it. If you're single, not married, and you have owned and occupied this principal residence for 2 out of the 5 last years, then you have a $250,000 exemption. And let's say you have 2 people that own and occupy this property, as each owning maybe about half. Each of you will be able to deduct off your taxes $250,000 of your profit or gain, and therefore you'll never pay taxes on that profit. Let's give an example here. Let's say that you bought your house, remember it's your principal residence, 8 years ago for $400,000. And let's say you sold it this year for $925,000. You will have some closing costs, and those are not included in your profit because you've paid them out. Okay, simple example. Married, filing jointly, you have a $500,000 exemption. You have, as you can see, $500,000 gain, and you'll pay no taxes. If you're single, you have a $250,000 exemption, and you will pay some taxes depending on your other deductions, etc. in your household, but you will have a capital gain that you will not be totally exempt from. And if you have two people owning the house, and you each own about half or half, you will each get on your tax returns $250,000 exemption, meaning you don't pay the taxes at all, and that's not counted as a capital gain. So, really, what you really are excited about is this is a special rule for owner-occupied principal residences, and you want to know about it. It's called IRS 121. It's called IRS 121. That's the tax code information, and it will not only save you lots of money, but you need to know about it, because if you lived in your house and owned it for 1.5 years, there would be some other rules and you wouldn't be able to take advantage of the same exemption. I'm Maxine Golden, your 1031 exchange lady. I started this channel for investors like you who want to save money on your taxes. Even though the 131, meaning your principal residence, isn't an investment property, small investors like you also have personal residence and want to save money on taxes when you sell them. So, if you'd like other tips on how to save money on your taxes, when you're dealing in real estate. Hit the subscribe button and you will see some other videos. I look forward to seeing you in the next video.